Let's talk a little bit about Social Security. Social Security is a critical piece of retirement planning for many individuals, and especially those at not as high an income level as others, probably rely on it even more than higher income folks do. But there's a lot of uncertainty about what the future of the Social Security system is, and there's uncertainty about how to plan around benefits. We see a lot of our clients trying to make bad decisions in that process because they really don't think it through and they don't think about how they maximize those benefits. Ted, you're the resident expert in the CPA community on Social Security. You essentially wrote the book. The AICPA has a guide to Social Security that was written by Ted Serinsky on the website. It's a great resource. Tell us a little bit about what you're seeing these days and what clients are doing in the Social Security area.
Okay. Well, one thing I'd like to point out first is that this uncertainty, is Social Security going to be there? The predictions are by the trustees that by 2033 there will only be enough coming in to pay out 75% of benefits. The way Social Security works is what's withheld from our pay and what comes in from the taxation of Social Security on people's tax returns is used to then pay out to the people who are on the benefit of Social Security, disabled folks, retirees, survivors. So right now there's an excess of accumulations over the years that's going to be used up by 2033. But still this money that comes in will be used to pay out for Social Security. So the problem is just 25%. So those folks who think, well, okay, it's not going to be there, well, it may not be there in full. It'll be there 75% of what it is today. So that's the worst case scenario. It's going to be 75% of what. So if you thought you're going to get $2,000 a month, you'll get $1,500 a month. It's not going to disappear. So I want to get rid of that one anyway. And I think a lot of planning comes in, as you said, Lyle, that if you have a lot of money, maybe Social Security isn't as important as to when you start, because I've got this pool of a lot of dollars that I can use to live off, if you will. But the less money you have, the more important Social Security becomes. Because now, if I don't have a lot of other money to supplement my income, I need to have the biggest monthly check I can get out of Social Security. And in couple planning, that's very important, that the higher earner of the couple wait until age 70. Even though they might have a life expectancy of 75 and they themselves may not get the full benefit of that, but a couple, if they both turn 65 today, one of them is likely to live to 95.
Right.
One of the two. That's statistically today. So if we do that and we look at that higher wage earner waiting to 70, that's the highest benefit they're going to get. They get 8% a year between 66 right now and 70. So they're getting 32% more than they would have at 66. The break-even point's 81. But again, one of those two is going to make it to 95. So that's going to be a tremendous difference. And remember, if you're starting early before 66, you start at 62, it's a 25% cut from 66. So you're not only losing that 25%, but you're losing all that cost of living increases for that next 30-some years as well. So as you get older and older, that difference becomes bigger and bigger. So in those couples, it's very important to wait. Tracy mentioned divorce, and what happens is if you are divorced before age 60 and you've been married for at least 10 years, you can use the ex-spouse Social Security record instead of your own, if that half might be higher. It's even better if that spouse died. Now, you can't cause the death, because if you cause the death, you don't get the Social Security benefit. But if somebody was married 2 or 3 times before age 60, they can actually pick and choose. And they were married at least 10 years to each person. They can pick and choose which person they'd like to receive benefits from.
Right.
Another thing that happens is, let's say you are married before age 60, you lose the benefit of those other spouses. But now you're 70 years old and your spouse dies. You could still go back to those other spouses and look at their records. So marriage planning, pick the next, pick somebody that was better than the last one in terms of earnings to get a higher benefit. So there's a lot of planning. Even single people at 60, at full retirement age, you can say, I want to file and suspend. That's a voluntary thing. So now I'm single, I file and suspend because I think I'm going to live a long time. I'm going to wait to 70 to get my benefits. I go to the doctor when I'm 68 and I find out I've got some type of terminal illness. I can then say, I'd like to go back to 66 and receive all the payments I should have gotten to that point in time, 68 or 69. I get all that back pay, plus I start at my monthly benefit as if I had started at 66 because I voluntarily said file and suspend. But again, most of the planning things you can't do until you are full retirement age, which is currently age 66. Those born 1960 and after, it's going to be 67.
Right.
So there is a lot of planning with Social Security. It is one of the only annuities that gives you an inflation protection, because it does go up by cost of living each year. They talk about chain CPI, which they wanted to institute a couple years ago, but that would lower the cost of living increases for Social Security recipients. Congress should do something, or will do something. They always have when crisis times have occurred. You know, this isn't the first time Social Security looked like they were going to run out of money. That's happened 3 or 4 times in the past as well. And there's been legislative changes over the years that have made it. One of the reasons why we're going to 67 from 65 is one of the changes that they made. So something will happen where they'll keep that a full benefit for everybody. So in planning, I still say we should be using Social Security. If you want to be really conservative, those who are going to become retirement age in 2033, use 75%. If you want to be real conservative, scale it back. Don't use the full amount. But I think using something is important, because even in a lot of planning I've been doing, Social Security, even for somebody who's very wealthy, still represents 16, 17% of what they're going to get. If somebody was a high wage earner and they're going to get $30,000 a year, that's like having $750,000 in an investment account to give you that annuity. So it's not small change.
Even a non-working spouse, they've got another, their 50% spousal benefit on top of that. It can be a big number.
So you're up to $1 million that you'd have to have saved to get that Social Security benefit. So Social Security is an important piece of everyone's retirement, whether they've got a lot of money or less money.
I think Ted's alluded to an important point here, that we really should be making sure we're doing very reasonable planning and not just ultra-conservative planning, because if we don't include Social Security at all, we're now forcing the clients to save more, work longer, and foregoing something they may want to do in the name of perhaps being too conservative for them. And so it comes down to a conversation about flexibility and how can they adapt to change in the future. But it's a good point that if we're conservative on every variable, they're never going to retire. They're not going to enjoy their life.
That raises a great point, David. Thinking about your comments that you've made and your practice and working with clients and helping to plan their life and really trying to do life planning with them. How do we find that balance between not being too conservative and leaving too much on the table, if you will, where they really haven't been able to do the things they wanted? I could see a client being very upset with you 10 years down the road, 20 years down the road, when you told them they couldn't take that trip that they wanted to take, or spend that, or upgrade, or buy the second home. But they ultimately could have, because things worked out fine. How do you manage that?
I think it all comes down to, I really see part of my job as managing flexibility and educating them about that. It's also one reason why I don't really use annuities in my practice. I think textbook, there's some great examples, and in certain cases in real life there's great examples, but depending on what portion of the assets we're using to go do that, we take away a lot of the flexibility to adapt to unforeseen circumstances. And being younger, clients have more opportunities to, with career changes or spending, to kind of get back on track if something happens that throws them completely off. However, I would still err a little bit on the side of conservative. I'd much rather have the client be upset with me that they didn't get to buy their second home as early as they would have than they bought the second home and now have lost both homes. So I think there is certainly a value of conservatism here, but that's one of the reasons why running multiple scenarios when you're doing the financial planning and showing the Monte Carlo analysis and showing that isn't a binary thing. The whole point of a Monte Carlo analysis is probability, and showing that there's an X% chance that you will have to make an adjustment. There's also a 70, 80, 90, whatever percentage you use, chance that you're going to have more money than you need, and we'll be able to loosen the belt later on. And so making sure they understand it and not just presenting it as yep, your plan works, you're good to go, but kind of seeing the range of outcomes.
Having that flexibility. And again, that comes down, reinforces the importance of that ongoing relationship with the client.
Exactly.
This isn't a one-time plan that you do and then you walk away and they go off on their merry way. You've got to be involved on an ongoing basis to get those course corrections.
Exactly. The process of planning is far more important than the actual plan.
Exactly.
Again, statistically, Lyle, whatever happens in the first 2-3 years of retirement kind of sets the stage for the rest of retirement. So if we can get folks past the first couple years of, if there's down markets, it's going to be tough to recover that type thing. If we can get past those first couple years, I see clients having a much easier mental attitude in retirement, because it's now, okay, I've settled into my spending habits, I see what's happening with my portfolio, I'm comfortable now. Those first few years of when they're no longer having that income come in like they did before is very unsettling for everyone that we've dealt with.
It's a huge amount of uncertainty. They're making a transition where they've done the same thing, they've done something that's generated a paycheck, that's given them cash flow, that's met their needs for 30, 40 plus years. And now they're shifting to a different environment. And it takes time to transition to that.
Right.
It's not an overnight transition by any means. But I think once they make that transition, you're right, then they do settle in more. And we've found actually a lot of our clients will actually spend more time tracking the detail of their expenses once they've got time to do it.
Yeah.
And they kind of like it. They're engaged in the process and really enjoying what they're doing.
Yeah.
And it makes a more productive ongoing dialogue down the road.
Right.